BioTransplant Incorporated was launched in 1990, focusing primarily on the research and development of proprietary anti-rejection pharmaceuticals and for transplanting animal organs. They are currently in need of an infusion of new capital to fund their company. The following presentation will take you through the process of deciding how to get the new capital to ensure BioTransplant continues to be viable in the pharmaceuticals market.
BioTransplant is a biotech company that develops anti-rejection drugs for organ transplantation, and at its current burn rate will run out of funding by 1998. The company has exhausted many different avenues for funding, including collaboration with researchers and big pharmaceutical companies, as well as 3 different rounds of venture capital funding from HCIC, which now owns 49.9% of the company. Elliot Leibowitz, who is the president and CEO of BioTransplant, is inflexible that the core technology needs to remain proprietary to the company. At this time, he will not sign this technology over to a big pharmaceutical company in return for funding. The company needs to attract investors with a long-term approach to investing, since the company does not currently have any marketable products and does not have any revenues coming in to help support its R&D efforts. Should BioTransplant decide to go through the IPO process, not only is this expensive, but one of BioTranspland's closest competitors, Alexion Pharmaceuticals, is further along in this process and could exhaust available funding in this sector. The choices that BioTransplant has for obtaining the much-needed funding for R&D are more venture capital, funding from insurance company or pension fund managers, more collaboration agreements, or going through the IPO process.
In the problems section, we have identified 3 major problems and the relevant symptoms. The first problem is that Leibowitz is too narrowly focused on the success of his 2 main products, Xenomune and Alloimmune. This can be seen by the several short-sighted decisions he has made to sell off potential revenue-generating products to competitors for a quick infusion of cash. This, in spite of the fact that this could have become a revenue stream, making BioTransplant more financially stable. Next, the only considerations Leibowitz gives to developing a new product to bring to market is in an attempt to sell it to a competitor. He believes that this strategy has been successful in the past for quick money, but does not wish to take time away from the primary drug research. Finally, all efforts and decisions that have been made from the company have been made with the apparent blinders on, meaning Leibowitz truly believes that the 2 main products will solve the company's financial problems overnight. The second problem is that the hopeful cash influx received from an IPO is going to be extremely expensive. First, there is no guarantee of success for the IPO, even if it's launched in the so-called hot window. Nor is there any guarantee that there has been enough interest sparked to make investors want to purchase the stock. Next, no cost-benefit analysis has been provided to determine what the cash influx would be on either a best-case or worst-case scenario, and how that relates to the very real cost of launching the company into a public market. Finally, launching an IPO will necessitate giving away trade secrets, revealing financial positions, and ultimately losing control of the company to whomever is the primary stockholder. The third problem is with the ego of Leibowitz himself. His ego has been tied so closely with the success of the project that he feels he cannot allow it to fail, and because of this, his decision-making has hurt the company's chances of success. First, his stated belief that he must be there long-term to ensure the success of the company shows that he believes that the company cannot hope to survive without him. Second, his own valuation of what his time is worth. The valuation precludes the idea that working on any other product which could add value is not worth his time. Third, his overwhelming need to revolutionize the market and his willingness to sacrifice anyone or anything to be the one leading that charge.
We will now connect this case to our business theory. BioTransplant has competitors close to their area of expertise. Alexion Pharmaceuticals Inc. is rumored to be farther along in the process of completing an IPO. Should Alexion complete their IPO before BioTransplant, BioTransplant would most likely not receive as much funding. It is generally known that a company that enters first receives a majority of the funding. Regardless of how Alexion is faring with their pharmaceuticals, they could receive much of the money that BioTransplant needs. This also means that BioTransplant would not have the first mover advantage. In addition to these disadvantages, and because of the nature and steps in going public, the loss of key information is probable, and those who were once trailing BioTransplant could catch up and overtake the company's place in the market. BioTransplant is trying to break the cost barrier when speaking of transplanting organs. A kidney transplant costs around $50,000 and a liver transplant as much as $235,000. Life support costs for a kidney transplant is $20,000 and for a liver transplant is $50,000. BioTranspplant's technology sped up the process. Getting a viable organ transplanted would negate the life support costs, saving recipients and companies money. This would give BioTransplant an advantage. Their window of opportunity to be leader in this market is closing. The product approval lifecycle can take up to 10 years. This creates challenges when dealing with how to earn revenue in the interim. Also, there are many drugs that do not end up making it through each phase of testing and never become FDA approved. Only 5 to 10% of all drug therapies were approved for sale, and on average this costs $359 million per drug through the phases. BioTransplant has no drug therapies in the market currently and are not making any revenue. Their current drug will not be available for market for at least 2 years if they do not have any setbacks. This product lacks the immediacy needed to produce revenue. BioTransplant is part of a small group that is breaking the idea that an organ being transplanted needs to be from the same species. The question is whether moving away from human organ transplants to animal organs is something the medical community will get behind. Is that a trade-off the medical community is willing to make? The company is being run like all other pharmaceutical companies. There is a lack of innovation in the way they operate. The same applies for the way they are looking to an IPO to raise money to fund their research. This is not a new concept, but one fraught with risks. These pharmaceuticals are valuable as they have the potential to save hundreds of thousands of lives by not only to cross tissue types, but allowing for animal organ transplants, which we have an endless supply of. This technology is rare in the medical field, though at least one other company is close to the technology as well. The cost to imitate is high, and most development of pharmaceuticals is, but other company is close on BioTranspplant's heels in the terms of progress. The only substitute to these drugs would be for a donor to wait to be tissue matched with a human organ, take the applicable immunosuppressants, and hope they are not some of the over 50% of patients that reject their transplanted organ. For the Porter's 5 forces, the barriers to entry are high. The cost of researching and getting approval for pharmaceuticals is on average around $360 million. This is a great cost to competitors. The buyer's power is low. Lack of viable human organs for transplant is few. There is a large backlog of patients waiting for transplants. The supplier's power is low. The cost of an animal organ is low, and there is a near endless supply. Threats to substitutes is low. This is the substitute for traditional practices of organ transplantation. Rivalry among existing players is moderate. BioTransplant is one of the few in the market, but there are other companies that may be further along in the process. The power of complements is moderate. While there are few drugs that complement BioTransplant's area, most drugs that could be used are already on the market.
So now we will move into our proposed solution for the capital needs for BioTransplant. It is our recommendation that they form a strategic alliance immediately with a big pharmaceutical company by selling a percentage of the rights to their Allimmune product. This is in exchange for an immediate capital infusion and assistance in bringing the product to market. The reason we believe in this, even though their CEO Leibowitz is dead set against it, is because survival of the company is paramount above all else. BioTransplant is still currently in a position of power to negotiate a favorable deal because they have enough cash to last through 1998. Plus, Allimmune will be their most favorably looked upon product because they still retain all of the rights to it. Xenomune, BTI, and MEDI have already had rights sold to it, and this is their most favorable product for other parties. In addition to all the benefits that BioTransplant would get from a big pharmaceutical company, an IPO is really fraught with complications and will just be too big of a distraction for management at this critical juncture in time. It'll be costly, it'll take management out of the office, and plus putting off an IPO is not a permanent measure. They can always wait until the next hot window opens. But the primary reason that the company is not more in favor of partnering with big pharmaceutical is due to President Leibowitz's bias. He truly believes that the drug will be released to set the company up for future success, but let's be honest, beliefs are just that. and this is an opportune time, the most opportune time, to diversify their risk. Now it's time for the specifics of our request. We would look to seek a $30 million cash investment from a big pharmaceutical company, as well as the assistance in marketing and distribution of Alimune product for 20% of the rights to all future revenues of Alimune. Now, the benefits of this of the BioTransplant are that a big pharmaceutical company will provide us their access to their network. Plus, at the current burn rate, the $30 million investment will definitely get us through until Alimune hits the market in 1999. So we won't have to do another round of investment. Plus, we have not sold off any of the company, so all future products are ours to keep. Now, the benefits of this to big pharmaceutical are that the estimated sales of Alimune, based on the current markets, will provide a net present value break even to big pharma just after year 12, if their desired annual rate of return on investment is 15%, so it's quite attractive rate of return. Now let's take a look at the updated proposed profit and loss charts. As you can see, the sales for the Alimune drug have stayed consistent in the year 2000 and 2001. We estimated that that's when the revenue will first be generated. However, the prepaid royalties, 20% of all revenues would go to the big pharmaceutical alliance part. So this slightly decreased our revenues. However, it is expected that 30% of the SG&A will be saved by using the big pharma distribution network. So if you go down to the net income or loss per share, year 1 is slightly less favorable, but year 2 and beyond are more favorable from an income perspective.
So to summarize our position, in evaluating BioTranspland's options for obtaining the necessary capital for their business, we believe that the best option is to partner with a large pharmaceutical company. By taking this action, they will be able to secure a stable funding source which will allow the company to continue developing and ensure that it keeps its doors open and can take the necessary steps to get its drugs developed, tested, and FDA approved. Additionally, this alliance will help BioTranspland's management focus on day-to-day operations and the core activities to continue the development of its products, both current and future. This is in contrast to the option of pursuing an IPO. In addition to being the second to the market behind Alexion, the necessary activities to prepare for an IPO could distract BioTranspland's management, making them largely focused on the SEC filings and paperwork. This loss of management's focus on BioTranspland's core activities could further delay their product development and put them even further behind Alexion. Also, partnering with a large pharmaceutical company gives BioTransplant credibility with other investors, which could help them obtain additional capital in the future should there be a need. The alliance would also provide instant experience to BioTransplant in that they gain the experience from the large pharmaceutical company in access to their marketing and distribution channels, drug testing and screening facilities, and also the invaluable experience of navigating the difficult FDA drug approval process. While BioTransplant currently retains all the rights to Alimune, BioTransplant is in a favorable position for negotiation. Although Leibowitz does not want to give away any of the ownership in their core technologies, giving their partner royalties from the sales of Alimune would help ensure that it gets successfully developed, approved, and marketed, since their partnering company would have significant self-interest to do so. This action would help to develop the immediate product, Alimune, without sacrificing the long-term potential for the company through future product development beyond Alimune. Additionally, our analytical estimates showed this strategy to have a positive net present value. This strategy helps ensure that BioTransplant can become a revenue-generating company and make itself a future big pharma company.